Investec's forecast was 2.9% for the third quarter of 2010. Consensus sat at around 3.2%, so slightly disappointing because we're sitting at that 2.6% level. Why do you think economists got it so wrong this time around?
You know, I think that the consensus for quite a long time has been that we're going to see GDP growth of above 3% this year. And obviously the first two quarters were fairly strong, so that expectation, I think, lingered. But, you know, the fact of the matter is we have been getting some very, very poor manufacturing data coming out on the monthly basis. And that really came through today in the GDP figures. You saw that the contribution of manufacturing, which is the second largest sector of the South African economy, was down massively, yes.
Yeah.
At the same time, we have some sectors doing okay at this stage. Agriculture growing 16.3%, mining 28%. Of course, mining is quite tiny in the greater scheme of things, isn't it?
And agriculture is even smaller. But I think the point is probably important that, you know, mining is growing well because there is strong growth in gold and platinum. And obviously, you know, gold is doing really well. Globally, the gold price is doing really well. So from that point of view, South Africa is still benefiting from some aspects of what's happening in the global economy. Because a lot of people will probably ascribe the weak numbers today, the weak GDP numbers, to the fact that the rand is so strong. But the reality of the situation is really that, you know, if the rand was so very strong and it would be impacting all the sectors, mining would be suffering as well, and that's actually benefiting. So, you know, there's actually quite a complicated set of numbers we had today.
You mentioned that most are expecting growth of over 3%. In fact, we've heard numbers as much as around 3.5%. And when you see the revised number for the second quarter down to 2.8 from around 3.2, it makes you wonder whether we can reach that 3% level. So this is basically showing that the South African economy still needs a lot in terms of growth potential when it comes to manufacturing, when it comes to the retail space as well.
Yes. Look, I think, you know, the point really is the third quarter was always going to be weak, you know, and that's why we did expect a fairly weak outcome because of base effects, because of the turn in the inventory cycle, and because, you know, we would expect to see a slight pickup as we move towards Christmas. But remember, most importantly of all, the third quarter was a strike action quarter. You know, so all of that did depress the economic activity. You know, going forwards, we still maintain our forecast. We see no reason to change it, that GDP growth will come out at 2.8% this year. I think the consensus obviously will be a bit lower now because of the actual outcome of the third quarter, but we maintain our view. And as a result, we continue to expect an interest rate cut in the first quarter of next year. Either in the January MPC meeting, but if it doesn't transpire, then certainly by the March meeting.
Okay, so you're saying today's data really justifies last week's cuts and really pushes the points away towards another one next year?
I mean, there's going to be nothing spectacular in the fourth quarter of this year. You know, we expect growth might at best come out at 3.5%. It's still going to give you a GDP outcome of 2.8% for the year. Next year's not going to be enormously strong either. And if you look what's happening globally, there is no major recovery in any of the advanced economies. You know, things really remain the same. In fact, you know, the concerns over the sovereign debt crisis are actually getting significantly worse with Ireland's problems.
What about the South African consumer? Because we saw retail sales really impressing the last month, and many say that we're going to see an even better Christmas holiday season. Do you think that that is going to then add to the optimism going forward when it comes to South Africa's growth outlook?
I think what a lot of people have missed with the retail sales figures that have come out recently is the fact that they were calculated off a low base last year. What that really means is there was a recession. Last year, retail sales fell year on year. They were negative. So this year, obviously, they're going to have a boost. They're going to come out stronger than if they were zero last year, because it's a year-on-year growth calculation. I think the point really is that if you take out that effect, you actually would have got retail sales that came out just recently of 3%. Now, that's significantly weaker than, you know, the headline figure showed. It's more in line with the GDP outcome, and certainly would expect to see a little bit of an increase over Christmas. But if you're looking at household debt levels of 80%, of close to 80% of disposable income, if you're looking at the fact that people who are only the people who are still current with their debt payments, is only 38% of all credit active South Africans are current with their debt payments. The rest are all in arrears. That's a fairly scary number. No, you won't expect to see consumer spending surging ahead massively.
Of course, we're getting CPI numbers out tomorrow. What's you looking for there? Do you think we're going to have seen inflation turning the corner between September and October?
I think, you know, the inflation figure is going to be a little bit jumpy between now and the end of the year because of base effects. You're likely to see it possibly come out at 3.3, perhaps remain at 3.2. That's not going to signal turning the corner, though, because I think it could still drop down towards 3% by the end of the year. But I think next year we are likely to see it turn the corner. We are likely to see it move upwards towards the 4.5% level if we don't get some significant currency strength, which is very possible given what's happened in the Eurozone. If the sovereign debt crisis does blow out again, we may well see very substantial, obviously would be expected, very substantial euro weakness, and that would obviously translate through into significant lowering of CPI inflation, because the euro is the most significant currency in terms of its impact on inflation, not the dollar.
We had Russell Lamberti from ETM on recently, and he thinks that inflation might even breach the 3% level and might even go closer to 2%. Do you think that is a possibility?
Well, I believe that forecast is based on the rand going towards 5 rand to the dollar. You know, so in that scenario, if the rand did obviously move substantially towards 5 rand to the dollar, which is 2 rand from where it is now, don't forget, then obviously we could very well see inflation move down to that level. I think, you know, what would probably prevent the rand from strengthening so very, very sharply would obviously be the fact that the Reserve Bank is throwing a huge amount of effort at preventing, along with Treasury as well, at preventing the currency from strengthening dramatically. They call it reserve accumulation, they call it lots of different names, but the fact of the matter is, for the rand to get to 5 rand, even with the enormous amount of effort that's being, the policy coordination that's being carried out both by Treasury and by the Reserve Bank, and the two of them together, that's going to be quite a hard ask unless we actually see some substantial deterioration in the global economy, either another double dip recession, as we said earlier, a blowout in the sovereign debt crisis, or indeed perhaps even the advent of quantitative easing 3, which is not an impossibility.
Annabel, we had liquidation and insolvency numbers out yesterday, and it looks like a bit of a mixed picture. Liquidations rising and looking pretty bad. Insolvencies starting to improve a little bit, though.
I think the point really is that when you're declared insolvent, you know, you're pretty much under legal management, and that's really the end of the line for many companies. I think, you know, for liquidations, that can be voluntary. And indeed, you know, the vast majority of the liquidations, almost 90% of them, were voluntary. And that really means that you can decide to liquidate or sell your company whenever you want. It's not actually an obligation in terms of the fact that you've got into a financial mess. And I think, you know, many of the companies who did perhaps not, who perhaps were suffering enormously and perhaps, you know, really battled in the recession, those ones have already gone. So what you're seeing now are the better managed companies that are perhaps deciding to go for liquidation on their own, but perhaps are not yet in the state where they actually need to be insolvent. So I believe it's still an indication of economic weakness, and I believe it's an indication that further jobs will be lost in the fourth quarter of this year.
Are we at a turning point, though?
Sorry?
Are we at a turning point, though?
In terms of?
In terms of liquidations, do you think we're going to see improvement coming through now?
Well, I don't think so. I think, you know, 27% down year on year is actually a massive figure. If you want to go to a positive, that's a bit of an ask in one month. So I think, you know, we'll probably see a turning point coming next year. But I think for
the worst still to come, perhaps?
Well, no, not so much the worst still to come, but I think, you know, we're likely to see further liquidations.
When do you expect stability, though, Annabel?
I would expect it in 2011. We move towards stability, because in 2012 we're looking to see a resumption of trend growth.